Hey there, I hope you're having a great day. It is a wonderful day in Houston, Texas. We had our first real cold front in a while. So it is 30 October, year of our Lord 2023. I'm Jim Munchbach, CEO and founder of Bayrock Financial. You can check us out at bayrockfinancial.com. Today, I want to talk a little bit about basic options strategies. Whenever you become a client of Bayrock, one of the things I will tell you is that our investment management, our discretionary portfolio management, includes certain types of securities that are made for trading options. Options is one of the things that we use, that I use in managing investment portfolios to manage risk, to generate income, and I'll tell you a little bit about how that works and show you some examples. And generally just make a profit, whether the market's going up or down or sideways. Options give you the ability to actually make a profit. Now, that doesn't mean that we always do it in a way with the right timing. There's lots of risk when you're trading options, and we'll talk a little bit about that. But the basic strategies that we use typically have the least amount of risk and give us, they're just a great tool to have in the toolbox. Options are to manage risk and, again, to generate income in your portfolio. So let me spend a couple of minutes. And first, though, before we talk about option strategies, I want to spend a minute and review our Riskalyze tool. One of the things that we do to start off, if you're a new client with Bayrock, you've already taken the risk survey. So you can go to KNOW, that's no, K-N-O-W, understand the risk that you have. And what we try to do is we start with the question, what is your risk number? What's in your portfolio? A lot of folks don't know what's in the portfolio. If you don't know what's in your portfolio, you certainly won't know how much risk you have. And so we start with a risk number. You can get that risk number when you take our quick 5-minute survey. And so I did a video. I do lots of videos to highlight the reasons that we want to use something like our tool, Riskalyze. It's now Nitrogen, used to be Riskalyze, but it's a fantastic tool, not just to help you understand how much risk you have in your portfolio, but it helps us manage the risk in your portfolio. So it's a starting point, and if you haven't done that, if you're interested in getting a portfolio analysis, then that's where to start. It will help us know how much risk you have in your portfolio. And it will let us know how much risk you want, because when you get the risk number, that tells us what risk you're comfortable with. So it's a tool that helps us help you manage risk in a way that allows you to sleep at night. The other thing it does, and one of the reasons that it's so important in terms of managing a portfolio, is how much risk do you need? We've been talking about inflation and interest rates and bond yields for some time, and we'll continue to do that. But the main thing is inflation is a risk. So if you have all of your money in cash right now, and you don't know this, let me be the first to tell you that you're losing money by having your money in cash. So maybe if you're like my wife Connie, you don't like to take risk and you think there's no risk because you're in cash. But if you look forward 10 years from now and you have all of your money in cash, you will have decreased your buying power because of inflation. So again, that's something that we want to keep an eye on. How much risk do you need to have in your portfolio? So that all starts with us doing a thorough and thoughtful review of your portfolio and your financial planning goals. And so I wanted to mention that before we get started and go back to the basic investing strategies that we use with options. Basic options investing strategies. So that's the point of this video. Let me jump on over and get that back up. So let me just take you to the basic idea of this video is to do a little training. This is a training video. It's education. This is not investment advice. If you're a student of mine at the University of Houston in personal finance at the Bauer College of Business, this is a great little video. We are doing a series on options trading to help students understand how to manage risk in their portfolio. Basic options strategies is what we're going to talk about. What I want to make sure, if you're a Bayrock client, you may know that we've been using some basic strategies in your investment accounts. If you're a prospective client thinking about hiring me, hiring Bayrock to manage your investments, then I want you to understand a little bit about basic options strategies for your portfolio. So that's what we're going to do. I'm going to give you a couple of real world examples so you can see what I'm talking about and what I actually trade in clients' accounts, in my own accounts, so that you can understand it a little better. Talk a little bit about common mistakes that folks make when they start trading options and how to avoid them. So let's jump right in and get to work with, and the last thing I want to mention before I just start showing you the post. I created a post today, I'll show you that in a minute, with a lot of information, and I'll cover some of it in this video. But the number one thing that is critical if you're going to trade options is which securities you select for the purpose of trading options. So of all the things I would say about learning, if you're a beginner, if you're starting out, you want to understand which securities you're trading options, and we'll talk about that a little bit. But again, this is an introduction. This video is an introduction. It is not going to make you an expert in trading options. I just wanted to do a little education for my clients and for some prospective clients that I'm talking with right now about the possibility of managing, either they will manage their investments with a little coaching and guidance and education, and that's what we're here for. But also for folks who may not want that burden, we have a pretty good deal in terms of cost. Our investment advice, our advisory services are priced very competitively for what you get, especially when we talk about option strategies. So I'm not trying to sell in this video, I'm just trying to educate. So let's jump into, I'm going to go to, give me just a second here, and I'm going to turn off this, turn on that, and get rid of, well, I'll just do this. So if you go to bayrockfinancial.com, you will see this post. That's what I'm showing you here on my iPad. My thumb is on my iPad. And so this is the post, and you can see that it looks similar to this video. There's a table of contents there, just to give you an idea about what we're going to talk about. But mainly, again, the reason that we use options, the reason I use options, by the way, I learned how to trade options from a guy named Tom Sosnoff. So if you're out there listening, Tom, or if you know Tom, give him a wave, a nudge, a howdy. He taught me how to trade options on the Chicago Board of Options Exchange. It was a training, but it was a pretty cool experience. And I believe I learned so much from Tom. And it's been many years, and I've been trading options since then. And so what I do for clients, what I do in terms of managing investment accounts, using the option strategies that I learned from Tom and on my own over the years, have worked really well. But the main thing I want to mention about options, basic option strategies, are designed to help be an additional tool in the toolbox for managing risk. But the way I use options is also and always to generate income. So one of the things I learned from my mentor, Tom, I think his favorite two words, if I'm not mistaken, it's been a long time, but I believe he summed up his entire training experience with two words, which was sell junk. I should have a title flashing on the screen right now. Sell junk, what does that mean? What I understood, what I learned, and what I've learned over the years is that the highest probability for success in trading options is to sell options, not to buy options, but to sell options. Now, there's a whole lot more to it, and we'll talk a little bit about that, and I'll show you an example. But selling junk means selling options instead of buying options. So I'm going to show you some basic option strategies that involve selling options. So basically, there's a call and there's a put. And every option strategy involves calls and puts. So you'll see here in a minute, I give you some basic definitions of options, calls versus puts. So I'm not going to read this article. I just want you to know it's here. You can go to bayrockfinancial.com and you can search options, and this article will pop up. Another thing is, why choose options over stocks instead of just buying the stock outright? Again, part of the strategy is to generate income, and options give us the ability to do that. So again, there's a lot to it. There's the Greeks, which I'm not going to get into in this video, but the Greeks are the terms, the concepts, the elements really that provide the pricing for options, and it's really important to understand those if you're going to actually trade options. And obviously one of the most important elements of managing risk with options is position sizing. So let's get into covered call. These are basic option strategies that I just want to highlight for a minute. But before I do that, I want to show you, I just want to jump over and show you a report that is available when you do the, let me get rid of that so you can see the report. This is a report that you would receive when we do your portfolio analysis. So I'm just going to thumb through this report just to give you an idea. So this is a sample report, and it shows a risk number. So that's a risk number. Typically what happens when you take that risk survey is not only do you get a risk number, but that gives me an idea how much risk you're comfortable with. So then I put together a proposal and I show you the investments that we would recommend. And those investments include ETFs, exchange traded funds. Now we occasionally do mutual funds, but mutual funds have a much higher fee and they have some other drawbacks. Exchange traded funds, ETFs, are by far and away the favorite investment vehicle for professional money managers, and so that's why we use ETFs, exchange traded funds. So as we go through this report, you'll see that most of these are ETFs, and the reason for that is these ETFs fit a very specific metric setup that is critical if you're going to trade options, and one of them is that they're very liquid. They trade in the millions, and the other one is that they have a very, very thin, razor thin spread between the bid and the ask. So the security itself, the ETF, the underlying security, in this case we're going to talk about SPY and TLT. I know that's kind of small, but trust me, SPY, it's one of the most traded investment vehicles on the planet. It is a proxy for the S&P 500, the 500 largest U.S. companies, and thus the largest companies in the world. So the SPY is an ETF. When you buy that, one share of that means you're buying a little piece of each of the 500 companies in the S&P 500. So that's just one example of the type of security that you want to select to do your option strategies with. And it's certainly the #1 pick at Bayrock. So again, when you get your risk number, you get this report, and it shows you the investments, each of the securities that we would be recommending in your portfolio, along with the certain elements or characteristics of each of those investments, which I'll highlight here in a minute. I do want to point out, though, that some clients have actual stocks in their portfolio, Typically, when we recommend a portfolio, it does not include individual stocks, although we're happy to include them, and we help you do a little research to figure out when to buy, when to sell, and what to hold. But at any rate, this is just a report that we generated, and one of the things that you get to see in this report is what we call a heat map, and it just shows how much risk you have in each of these investments. Which of these investments gives you the greatest potential for gain and also the greatest potential for loss. And so it's just, again, it's a helpful report. Another thing that we will show in this report is the annual distribution rate. So one of the things we do with all of our ETFs is we look for, again, super high liquidity, meaning that easy to trade, razor thin spread between the bid and the ask, so that you're never caught having to bargain with a market maker on either buying or selling an option on that security, or if you're trading that security outright, which happens a lot when you're trading options. You get a stock put to you, an ETF put to you when you sell a put, especially a naked put, which we'll talk about in a minute, or if you sell a protective call or a covered call, that will get called if the price of that, say SPY, goes up. I'm going to show you an example in a minute where I put some calls on SPY today. And it's very likely that the price of SPY will go up so that the value of that call option will be a losing trade for, basically, because I'll show you in a minute how that works. But when you sell a call, a covered call, and the price of that underlying stock goes up, that stock's going to get called away at the strike price of the option. So it's just something to be aware of. And so my point is, you want to be using underlying investments, underlying securities, ETFs in this case, SPY specifically. You want to be using ETFs that are super liquid, super easy to trade, so you don't get hammered on the price between the bid and the ask. And so also the other thing I wanted to mention is the distribution. We look for ETFs that have a relatively high distribution, so you're getting some kind of dividend for holding that particular security. So we'll look at that again in a minute. Another thing here is expense ratio. I already mentioned that. If you look at the list of the ETFs in the report that we will generate for you, you'll see that they have a relatively very low expense ratio, which sets ETFs apart from a mutual fund, which can have a much, much, much higher expense ratio. So ETFs, again, are my favorite vehicle. Now, this part of the report is really helpful. It shows what would happen to your portfolio in the event that we have another great financial crisis, another rate hike situation. What else? We've got a bear market. So different scenarios and what would happen to your portfolio compared to the portfolio that I'm proposing, and then compared to the S&P 500. So those are all parts of this report. I just wanted to highlight that report. Let me get to the front page, and then I will get out of this report. So now I'm going to go back to the post. This is the actual post. So I listed some of the basic options strategies, and I want to just kind of talk a little bit about my favorite. Number one is covered call. It's a way to protect your investment. Let's say you own 1,000 shares of SPY, and we're concerned that the market may pull back, may go down. Let's sell some call options on your SPY, and I'll show you what that looks like in a minute. That's my number one. These are not listed in order of my preference. They're just to give you some information about what basic options are available. The last one on the list is called a naked put, and that would be actually that's where it all starts for me. I think the naked put is probably the best beginning place for an option if you don't own a stock. I'll show you how that works. I just want to mention, this is educational. It is not investment advice, but I do want to mention that a naked put is great for income generation, but it has a lot of risk. So I'll show you how that works in a minute. Well, I'll show you right now. Here's here are the real world examples. So first thing I want to show you is a put. Now this, I took this screenshot today. I'm going to just jump on over to the market today. This is the market today. So let's look at the SPY. I'll just show you. This is the SPY. That is an ugly chart. That is a very ugly chart. However, if you look all the way to the right, you see that green candle. I wish I could expand that, but I can't. It's just a chart. It's not a picture, or I would expand it with my fingers. But if you look all the way to the right, you see a pretty long candle, and that means that thing started low and it just kept going up and up and up. The market, if you can see those numbers, let me get rid of my face and you should be able to see those numbers. Yeah, you see the very top left, 511 is the Dow, and those are the numbers for how much the market went up today. The market went up a lot today. So why am I sharing that with you? Because I just wanted you to know that if we decided to sell a naked put on SPY today, it wouldn't really be a smart move because SPY was up. We want to sell naked puts on days when SPY is way down, which we did a few weeks ago, but I didn't grab a screenshot. But if we did sell SPY, if we sold 5 contracts with a $415 put strike price, that means if SPY closes on December 1st above $415, then you would get to keep all of the premium, that $3,645. That's, in essence, a naked put. Why do I love naked puts? Because if you were going to buy the S&P 500, today might not be a bad day to buy the S&P 500, just to go buy the SPY. And again, if you bought the SPY today, this chart tells you what you would pay for it. You would pay today, what are we looking at? We're looking at a price of $415. It's a little bit covered up there, but you see at the top, about in the center, $415.59. So if you just bought that today and you look at this chart, you may be thinking what I would be thinking. If you look at that chart, it has gone down, down, down. Could it go down more? It certainly could go down more. However, because it's gone down so much, so fast, so recently, chances are this is going to go up. I think it's going to go up. I would want to be long this holding. However, today was a day that the market was way up. The market's been very volatile, going up, going down. That typically is an indicator that we could have some pain coming our way, but it's certainly been volatile, meaning it's going up and it's going down, and that's the best time to trade options if you're selling options like a naked put. So even if you would have sold a put today, you would have received $3,645 for that, for 5 of those. So what would we receive for one? Looks like $7.31. That's what we would have received for each share. So that's $700, $730 for one contract, which represents 100 shares of stock. So that's a naked put. Now this is the TLT, which is basically a 20-year bond. And if we sold a put on it today, if we sold 20 of them, that would represent 2,000 shares of TLT. You'd have gotten paid $3,500 in premium. Now I wanted to just show you, this is what it looks like. So we sold SPY a while back. Let me see if I can find, yeah, so this is the put that was sold. No, actually that is, yeah, that is a put that was sold. And it was, so this is a put that I sold a month or so ago, and you can see that it was a $415 strike price. Well, Friday was the 27th. And Friday came and it was below 415. So everybody who owned this particular call or this put option, this naked put, they got paid $2,000. They got paid, this is for five, I think that's 5 contracts. They got paid $2,000. And so I wanted you to see that when they got that stock, SPY, put to them in their, they're showing a loss right now of $679. But what you're not seeing is you're not seeing the premium that was received from selling the naked put. So now we turn around, and because SPY was up so much today and because the market's so volatile, what I did was I just turned around today, and this may have been a mistake because, again, remember, if the market goes up, which, again, when we look at this chart, what do you think is going to happen to the S&P 500? Let me get that chart. If I can get that chart to pop up. Do you think that's between now and December 1st, do you think that stock, that ETF, SPY, is going to go up or down based on that chart? Now, you're probably as smart as I am, maybe a lot smarter, and I'm always trying to identify probabilities of success. When I look at that chart, if I had to bet $1 that it's going to go up or down or just go sideways, I would bet that it's between now and December, knowing what I know about this time of year being seasonally more likely to go up at the end of the year for lots of reasons I'm not going to talk about in this video. Looking at that chart, I would say if I had to bet $1, I'd bet the $1 that it's going to go up. So based on that assumption, that wild assumption, it would be foolish, it would be foolish to sell a call. Let me find my call. That trade right there would probably be foolish if it's going to go up. However, because I'm basically working a portfolio for my clients and for myself, because I'm sitting on a loss right now because I sold a naked put, and today SPY is way up. So today, if I sell call options on that same pile of money that I used for SPY, we get paid $4,500 to sell at the money. It's at the money because today, when this was traded, SPY was trading at $415 a share, so that is called at the money. And so that call is selling for $4,500. So if SPY goes down, if December 1st it closes at $214, the client gets to keep that $4,500 premium. That's generating cash in their account. Now, if the stock, the SPY, closes at $430 a share or $450 a share, what happens? Well, this number is going to turn really red, and it's going to be, look, this trade, this options trade is going to be ugly. It's going to be a loser. But the good news is you own the SPY, 500 shares, and it's going to go up. You know, if it goes to 450, that's how much it's going to go up. But you're not going to get that benefit. You're not going to get that benefit because you're going to be losing on this option. Now, what I'll do, just so you know, is while I put this trade on today, I'm going to be watching it very carefully between now and December 1st. And if it looks like things are changing in the market and if it starts to rebound, then I will take that call off and we will hope that SPY continues to go up. And then I will just put another call option on when it gets to a place where it looks like, when I'm looking at that chart and I'm saying, okay, saying the same thing I'm saying to you today, you're looking at that chart now, and let's say that it was, back in August. You can't really see because I don't have the whole chart there, but you see the very top of that chart. If the SPY goes up, up, up and away and gets to the very top of its range, then that's definitely a good day to put a call option on, to put a covered call option on. If you own 500 shares or 1,000 shares or 10,000 shares of SPY, it's not a bad idea when we get to the top of that range to go ahead and sell some covered calls. And then you get to receive that premium if the stock, if it goes down, you keep all of that premium. If it goes up, it gets called away. So you no longer have the stock now. You have all that cash in your account, so we can wait for the next opportunity to do what? What would we do next? We would, if I can find, where did I go? Brain freeze, sorry. So we would just wait for an opportunity to sell a naked put. And again, this is not, so that's what I did here. I sold a naked put. And I got a pretty good premium for selling a 415 strike price. It was about a 30-day. That's what I generally do, because the reason we do 30 days, 30 to 45 days, is because theta, that's one of those Greek words that we didn't really talk about, but it's in the post. Theta is time decay, and it's one of the major elements of an option, call or a put. When you sell an option, you have theta, time decay, and that time decay melts away over time. And if the stock price doesn't do anything, if it goes sideways, then that theta, that time decay, works to your advantage, and you get to keep that premium. If the stock doesn't go above the strike price within the time frame of the call option, then you get to keep all of that premium, which is the whole game. Like my friend Tom taught me, we're selling junk. Our hope is that we get to collect that premium, hold the stock, especially if we're talking about TLT. You know, there's a lot of risk right now in TLT, and a lot of folks are not trading it. They're staying away from it. They're afraid of it, and I get that. I'm afraid of it too. If you look at the losses in your account, if you own TLT, I'm sure you have losses. I do, pretty big losses. But the good news is we've been selling call options on that, so you're getting the premium. Every time that stock goes down, you get all of the premium on that call option. And eventually TLT is going to have a rip snorting uptrend. And let me just show you that chart real quick so you can see what I'm talking about. TLT is just been hammered, and it has to do with yields, with interest rates, with inflation, and I did a post earlier on that. You can go back and watch that on the YouTube channel, which, by the way, I should probably put my YouTube channel up on the screen so you can subscribe to this video and other videos that we post. And when you hit the little bell, you will get notified when I'm going live or when I'm posting a video. So just giving you something to think about here with options. If you're a client, I want you to understand how options work. If you're a prospective client, I want you to know how we manage investments, and that's what this educational training video is for, to introduce you to basic option strategies. So I'm going to see if I can get back to where I started. And yes, okay, so here's where we started. And I wanted to, let me just make sure we've got this. So we covered security selection and the metrics, some of the metrics that we use for that purpose. So we covered how to avoid, we didn't cover too many of the common mistakes. Let me just highlight a couple common mistakes. Trading options when you don't know what you're doing, that's a common mistake. Trading too big of a position, common mistake. Trading options on securities that really should never be traded. And again, liquidity, how many shares are trading? What is the spread? If it should be a razor thin spread. Like, for example, if we go back to, I'm going to jump back over to this chart and just show you, now it's after hours. After hours is never a good time to look at a price. But during the day, if you look at this SPY, during the day, you can't see it on this chart. But during the day, so now after hours, it's trading 415.31 is the bid, 415.38 is the ask. If it were daytime, if the market was open, it would be a penny. There would only be a penny difference between the bid and the ask. And that is, my friends, the number one mistake, I hit the wrong button there. That's the number one mistake that I see people making, is trading the wrong security. And so if you want more information, just leave a comment, let me know. I'm happy to do another video to go over more of the common mistakes. But the common mistakes, that's the number one common mistake, is folks don't know what they're doing. They start trading larger contracts than they have any business trading, and they're trading securities that really don't fit. And I've seen a lot of really smart people, professionals even, trading options on securities that really should not be trading options. So that's the common mistakes, how to avoid them. I gave you some real world examples. And again, this is all about risk management. It's basic options strategies, and it's training, education. It's not investment advice. So I hope that was helpful, and I hope you will like this video and subscribe to the channel and share it with a friend. If you're a Bayrock client, this is just my way of helping you understand what we're doing in your portfolio. I know these days have been pretty crazy. The market has been very volatile. I think that's going to continue for quite some time, and that's why I believe that the best way to manage your investments is with option strategies like the ones we talked about today. So if you're feeling a little uncomfortable with the amount of risk you have in your portfolio, whether you're a Bayrock client or prospective client or just someone doing it yourself, a do-it-yourself investor, these strategies can help you manage risk, generate income, and what else? And make money, whether the market's going up, down, or sideways. But you definitely need to know what you're doing. If you need a little help, want a little coaching, give me a call, send me an email, and I'll look forward to seeing you in the next video. So I am going to hit the finish button.